continuing to build. So how much more downside do you see for the greenback?
Well, quite a lot. I mean, obviously the key driver of the weakness that we've seen since the last couple of months, obviously partially reversed during the course of June, has clearly been led by the precipitous decline, if you like, that we've seen in US yields and differentials between the US and the rest of the world. And, historically those things play out with a bit of a lag. We've also noted that at the onset of every Fed easing cycle, going back to the 1970s, effectively, or the 1984, the US dollar has always fallen initially. So on that basis, we're still expecting that unless the Fed surprises the world by doing nothing when it beats at the end of the month, that there is still scope for the US dollar to weaken a little bit further from here.
Yeah, well, let's talk about that Fed easing cycle. Can you even call it a cycle? We might get 25 basis points in June, possibly 25 more before the end of the year. Is that going to be it, or do you think there'll be more to come?
That's the $64,000 or $1 million question, of course, isn't it, really? Is this going to be insurance easing? Charles Evans, the president of the Chicago Fed, was out on Friday talking about 50 basis points of easing should help get inflation expectations up and show the commitment to the inflation target. I'm not convinced. Looking at the Fed's preferred targeted measure of inflation, that PCE deflator, still to us looks as though it's stuck around 1.5%. And although we saw those slight upside surprises in producer prices on Friday and consumer prices earlier last week, the read-through from PPI and CPI through to that PCE deflator measure is almost non-existent. So we don't think that there's any evidence as yet that inflation is actually starting to track higher. So even if we get 50 basis points between now and year end, which is what we expect and is also consensus, far from convinced that that's going to be the end of the cycle. So even if the economy looks like it's benefiting from that, I think the key is going to be whether we see any signs of inflation picking up. And at the moment, inflation is pretty hard to find.
So what does it mean for U.S. dollar long term if you see some weakening at the initial Fed rate cuts, but then what happens afterwards when it seems that the rest of the world is also weakening?
Well, it's a good question, but obviously the rest of the world has far less scope, with a few exceptions. In this part of the world, obviously, there is a bit more scope for nominal rates to come down closer to zero. But, short of embracing, something like modern monetary theory, it's difficult to see how the likes of Japan and the ECB and the Bank of England can come close to matching what the Fed has the scope to do. So, on that basis, would still say the risk is that yield differentials will continue to play out negatively for the US dollar. We also look at the dollar structurally and from a sort of a longer term cyclical perspective, and there's no denying that the US dollar is quite significantly overvalued here. So that sort of figures more into our kind of longer term or medium term forecasts. But it's far from assured that the US dollar is, if the Fed does end up only needing to do 50 basis points and we do see further easing elsewhere, the risk is that this US dollar is going to stay stronger for longer.
Well, we continue to hear chatter about the U.S. potentially getting into the FX markets, don't we, especially with the president being so focused on the strength of the dollar. How much credibility do you give to those people?
Not very much, except we have a Trump presidency, and the fickleness with which he's tended to operate obviously means that we can't dismiss out of hand the risks that he does actually instruct the Treasury that he wants the Fed to intervene. So, the history of intervention is it's only been effective when it's been coordinated with other G10 partners. It has to work with the grain of monetary policy, and obviously if the Fed is easing, that would be supportive. But, I think the risks of this sort of threat, if you like, and a lot of banks obviously are talking about the risk. We hear that President Trump, when he was interviewing his prospective Fed nominees, was sounding them out about the strength of the dollar. So it's a threat that we can't dismiss out of hand, but I still think the chances of that threat turning to reality anytime soon are still pretty slim. I'd put them at no more than about 10%.